Okay, here's performance measurement. Now I've already made some changes. This is from what's on Desire to Learn right now. All I did was do the pivot table and get the dates lined up. You want to make sure this is the Fama French stuff right here. You want to make sure those dates line up with the dates with your stocks, and I will tell you what date to start with. Let's go down to the bottom, and I don't have data from Fama French for November and December. I just got to get rid of that. If I don't have the data, I can't do any tests with it. Okay, so back to the top here. Freeze that top row so you can see what's going on. Now I don't need this date column anymore. Just clear those contents out, because one of the things I want to do, IWM, this is the ETF for the Russell 2000. This is going to be my benchmark. It's not part of my portfolio. So let me put it right there so I can have all my portfolio stocks together. And also, the way the data comes from Fama and French, the risk-free rate is stuck right here. I want to put it over here for when I do regression analysis later. Okay, so now to do my portfolio, let me insert right here. I'm just going to put, like I said, I want you to choose the weights randomly, your gut feel one, and I also want to have where we do it from the different models. The only thing with the gut feel, the only thing that you have to do is make sure these things sum to 100%. So there's a little check, they sum to 100%. So now I'm going to form what I call my portfolio. And what I want to do is have this 20%, and that's not going to change. I hit the wrong button. So this 20%, that's not going to change, times, I can get it to work, times the return plus the weight of Amazon, which doesn't change, times its return plus the weight of Caterpillar, times its return plus the weight of Disney, times its return plus the weight of 3M, times its return. So that is the return for the first month of my portfolio. Double click that down. Those are the returns for all the months. 1 second, please. Okay, sorry I was interrupted by my little girl. Okay, where was I? So here's the portfolio return for each month. But I want to have the excess returns above the returns above the risk-free rate. So I subtract the risk-free rate. Click that down. Now these are my monthly returns that are above the risk-free rate. So my Sharpe ratio is equal to that average. Control up, right there, divided by the standard deviation of the same set of data, and there's my Sharpe ratio. My trainer measure is going to be a little bigger. It's going to be the average. Again, the exact same numbers. Period, control up. Divided by the beta, and for beta I can just say slope of my portfolio is the Y's. So this, period, control down, comma, my X's are the market, and notice this is the market right here, and that this is the RF means market minus risk-free rate. So like my portfolio has the risk-free rate subtracted, so does the market, and that's my trainer measure. Now I can put those in a good format. Next, to do Jensen's alpha, I need to go to data, data analysis, come down to regression, click OK. My Y range is going to be my portfolio, and I'm going to highlight the actual label of the column portfolio, because I've highlighted the label, I highlight the label and run that against the market. And let's see, let's put it right here. And let's talk about these results. Let me get the 4 main so I can look at it a little bit better. So I had a positive alpha, that's good. If I annualize this alpha, monthly data, so multiply the alpha by 12, have an 8.8% alpha, that's how I would quote it, right? The p-value, if the p-value is less than 0.1, is significant at the 10% level, less than 0.05 at the 5% level, less than 0.01 at the 1% level. The way to think about this, if I say 1 minus the p-value, I am 95.62% sure that my intercept, my alpha, is significantly, or that I'm 95.62% sure that it's different than 0. In other words, there's no randomness there. I'm pretty sure you actually did beat the market on a risk-adjusted basis. Okay, but let's do another step here. When I say you beat the market on a risk-adjusted basis, all I looked at for risk was the market. But Fama and French said, no, it's not just the market. It's the size risk. There's a market risk, a size risk, a value risk, up, minus, down, and momentum risk. So let me highlight all of these. We'll put this right here. And because you did the labels in the first row, by the way, you can see that I can see all those numbers much more easily. And now, let me look, did you still have a positive alpha? Yes, you did. Let's multiply by 12 so I can think of it in annual terms. And let's give it a percent there. 7.37, it went down from 8.8. That makes sense to have more risk parameters in there. Is an alpha positive? It's significant, yeah, but it's on the borderline. Most people would say, 0.1 or less is significant, and you're getting really close to 0.1, so it's not as impressive. Did you take market risk? Yes, market risk, because is this positive, is significant. Did you take size risk? Not exactly. It looks like in this particular case we were driven mainly by market risk, and these other risks were insignificant. Okay, here's the thing you're not going to see someplace else. I'm going to look at my portfolio minus the benchmark. So I take my portfolio return for this month, subtract the benchmark return. And what I'm saying is I could have, you're my small cap manager. All right, so I tell you to pick small cap stocks. Now these are not small cap stocks. So, I mean, the manager didn't pick the kind of stocks you want, but I'm just trying to pick stuff to come up with a portfolio. So you could, if you wanted to, say I'm going to invest in the Russell 2000 ETF, or I could find a manager who invests in those type of stocks, but does it in a better way, more efficiently, makes me more money. So your returns as my portfolio manager, and I'm paying you big fees, should beat the benchmark returns. You didn't in the first month. Let's copy it down. You did anywhere it's positive. Your portfolio outperformed the benchmark, and that's good. So the question is, did you actually outperform? So how often were you positive, and is that just random or is that real? So we run the regression. Same x variables, but the y variable is going to be this benchmark. And what I do for output range, I'll go right here. Now, this alpha of 7.37% means you beat the market on a risk-adjusted basis by 7.37%. That's great, that's awesome. But it could be that every stock in the Russell 2000 beat the larger market, because the market here is all the stocks that are traded. Everything on NASDAQ, New York Stock Exchange is included in this. So it could be that you just, I told you to pick stocks from the Russell 2000. They all went up. They all beat the market. It's not that you're a winner. You just picked from a pool of winners. So of course you won. So now I'm going to look at this. And let me get the numbers good. Did you outperform the index? And the answer is yes. Let me annualize that. Wow, you blew away the index. I could have invested in that ETF, but you made me 8.54% more, and that's significant, right? Did you take the same, if you took the same level of risk from market size risk, value risk, and momentum risk, these numbers should all be 0. So I'm telling you, look, I want you to be in the same style. They should all be 0. Look, the size is not. You took less size risk than I wanted you to. Look at the stocks you bought. These are all big stocks. So you didn't follow this. You didn't follow the style of investing I wanted you to. If you had, all these numbers would be 0, and they're never going to come out to be exactly 0, but these p-values would be large. So you did the same type of value investing and momentum investing I wanted you to, but you took more market risk, a higher beta, and less size risk. So that's performance measurement. And I just want you to be able to repeat that and understand what it means.